to everyone who's joining us today for our webinar on the evolving European ETF market, and thank you for taking the time to do so. My name is Brian Higgins. I'm a partner in Dillon Eustace and a member of both the Irish Funds and AFAMA ETF groups, and I will be moderating today's discussion. As a matter of housekeeping, I should mention that in the interest of time, we'll try to cover topics as succinctly as possible. However, we are recording the webinar and it will be made available to all attendees after the event. And please also feel free to contact any of us if you should have any follow-up queries after the event. The purpose of today's webinar is to discuss the growth and development of the European ETF market and the means by which new entrants may choose to access it. We have a great panel to discuss these topics, namely Antonette Kleiser of BBH, who is one of the leading service providers in the area, James Carberry of Virtu Financial, which is one of the leading market makers, as well as our own Shane Coveney, who is a partner in our asset management unit and advises a number of our large and successful ETF issuers, and Tara O'Callaghan, who leads our foreign registration and listings team. By way of background, the ETF market has continued its strong growth over the last number of years. There is now in excess of 3 trillion in AUM in the European ETFs, of which nearly 75% is held within Irish domiciled ETFs. And most commentators are predicting that this growth factor will continue into coming years based on product innovation. And we've seen the evolution of the use of the ETF wrapper from passive index tracking ETFs through factor, smart beta, thematic, and now active ETFs, and even within active from benchmark aware to high conviction active. An increase in retail participation, which has been led by Germany, but in line with the EU's SIU, is expected that this will also grow as other markets introduce tax incentivized savings products and the new wave of tech-savvy investors who are comfortable using neo-brokers and robo-advisors. So with that background, perhaps I could ask Antonette if you could start us off in the discussion on trends in the market, and in particular what type of ETFs are coming to market and where we're likely to see future growth.
Thanks, Brian, and thanks for including us in today's conversation. It's probably timely in the sense that BBH has just released our sort of annual ETF investor survey earlier in March. It's the 13th year we've surveyed investors across Europe, the US, and Greater China. This year we focused on sort of uncharted opportunity. We wanted to look beyond kind of the year-on-year growth and assess the path forward for the industry from the investor's point of view. So the survey is available on bbh.com, but I will highlight sort of just very quickly some of the key findings. ETF adoption remains strong, but usage of ETFs is evolving. So there's lots of stats here, so excuse me if I'm reading some of this. 94% of European respondents plan to increase ETF exposure over the next 12 months, but investors are becoming more deliberate about how they use ETFs. That figure is about 96% globally. In response to the current environment, all of the geopolitical uncertainty and the market volatility, investors are reducing equity risk and they're reallocating towards income, fixed income, defined outcome, and low volatility strategies. In Europe, what we're seeing is that dividend income strategies were defined as a top priority. Active ETFs continues to gain traction. Responses are showing that 66% of investors are favouring active management over passive in this current environment. 98% are planning to increase exposure to active, driven by things like risk control, flexibility. 94% of those surveys believe that active ETFs will reach 10 trillion in assets in the next 10 years. Number 3, investors are showing strong interest in innovation. Private market ETFs are an emerging theme that is gathering significant interest. 56% of European investors said they would consider buying private equity if it was available in an ETF wrapper. 51% would consider buying private or credit. 82% of respondents would invest in an ETF share class of a mutual fund. This was higher in the US at 86%. Fourthly, access and education are still holding the market back. 94% of European investors perceived issues when trading ETFs. 50% citing sparse ETF availability on platforms and lack of education resources. Investors are demanding more information from issuers, 55% noting that strong marketing support and education resources are a key way to increase value. And perhaps maybe just finally, 58% believe tokenisation will create improvements, but not fundamentally change how markets operate. 22% saying it will, revolutionise financial markets. Looking at BBH's own book of business, it's really all about active. We see a lot of, possible new entrants exploring their options, particularly European active managers. Sorry, back to you, Brian.
Thank you. Antonette, it's great to have that insight into where the market is, and from your survey, where we think the market is likely to go. And I might ask James to touch on what Virtu has seen. Does it tally with that? And also, who you see coming into the market, and with the focus on active as well, why it's important to engage with APs at the outset.
Yep, sure. Thanks, Brian. And first of all, yeah, I fully agree with all of Antonette's findings as well from that BBH survey. That is something that we're seeing on a daily basis at Virtu. So we market make and price almost every listed ETF globally. We started to see the active trend in the US about 3 years ago, really kick off. And we noticed it in the last maybe year or so, really taking off in terms of single stock underlying leveraged active ETFs, backed by single stocks, swaps, options. So the trend there has been kind of moving more towards the active side in terms of the number of listings. To now, we're at a stage where about 80% of every new US ETF we had is active. So we've noticed similar in Europe as well, where the trend to the new listings is more shifted towards active than passive too. It's often we get questions because of our relationships with issuers in the US. We often get questions there on how do we enter the ETF market in Europe if we were to list funds, and it's them seeing the opportunity for active in Europe as well. So we have noticed a lot of new issuers come into the market in Europe over the last year or so. But as well as that, it's great to see some like homegrown European ETF asset managers wanting to list ETFs in Europe, and often they're listing these ETFs alongside existing funds that they have. They have an existing strategy that works well, and they're looking to diversify a little bit, but as well expand the pool of clients that they if they can have access to gather funds. So there's trends on both sides, both on the from existing issuers in the US to brand new issuers in Europe. One other interesting trend we're seeing is that when we look at the fees, so the average fees, the management fees that these funds are charging, it's kind of easier to see as in the US with the volume of active ETFs they're listing. We see that the gap between the management fees on passive and active have collapsed massively over the last 2 years, to the point where on average, the new listings where they're active versus passive, the fees are almost indistinguishable between two. So it's good to see that the issuers that are existing in the active space are here to stay. They're looking at efficiencies. They're reducing the costs, both cost of entry for new investors as well as their own operational costs in terms of the primary market. So that all goes to reducing the fees on their side, reduces the cost of entry, and ultimately reduces the spreads from our point of view. So plenty of trends on the active side there.
Could I ask James, just in terms of the move from, as I say, benchmark aware active to more high conviction active, I presume there would still be a differentiation in fees there, given the nature of the product, and that's why it's important for the truly active managers to engage with you guys to, as you say, make sure the spreads stay as narrow as they can.
Yeah, exactly. Really up until now in Europe, we've seen almost benchmark plus active strategies, where it could be an option overlaid strategy. That potentially is an existing strategy in the US that's just being replicated in Europe. It's only really in the last maybe 6 to 9 months that we've seen real active strategies being listed in Europe in volume. And yes, the the engagement with these issuers, often new issuers, the engagement with them is so important to understand, one, how the fund operates. In terms of the turnover in these funds as well, it's very important, particularly for that communication in what the fund is holding at any one time. It's important for market makers, obviously, to be able to create fair values and market make these funds intraday, to know that what the fund has at any one time. For example, they're trading intraday. It's important to communicate that to the AP, so that the AP can then change their models and be able to still be confident in market making the fund.
Great. And then could I just ask Tara, what are you seeing, or how are you seeing the market evolve at the moment?
There's been a number of really positive developments over the last 18 months or so. And I think the first key one is the reopening of the UK market post-Brexit to new ETF issuers, because following the launch of the overseas fund regime, this now allows these new ETF issuers, which were locked out for up to 5 years with no path to getting recognition to market into the UK. So now they can make application under the OFR, which is a prerequisite for listing on the London Stock Exchange, which is one of the key markets. Another really positive development is a Euronext initiative. Euronext operates 8 market and trading venues across Europe, but 3 of their key markets in Amsterdam, Milan, and Paris have high liquidity in ETFs, but very often multiple cross listings. So last year they launched, I can't say this, Euronext ETF Europe, all the E's. So Euronext ETF Europe is a platform whereby, with a single listing on one of those 3 venues, so Paris, Milan, and Amsterdam, which are the key liquidity venues, will facilitate your trading on all 3 of those exchanges if you want, from a single listing. So it's a really positive development, so aiming at reducing the fragmentation that's such a key characteristic of the European market so far. Deutsche Börse has always made some changes. It has reduced one of its listing processes. There are 3 key processes to getting a listing in the Deutsche Börse, and one of those has now been moved to just a notification phase, which is simplifying the process a little bit. They've also gotten rid of the requirement to have a German local sponsor, so that makes the process a little bit more straightforward. And then on the wider distribution side, there's 2 initiatives that may well advantage ETF issuers. One is the possibility to access Latin American investors through a listing on the BMV in Mexico, which is a very straightforward listing, which is based on a 3-month trading history on another exchange. So it's another option and opening up other markets to ETFs. And then finally, last year, we had a memorandum of understanding between Hong Kong's regulator, the SFC, and the Central Bank of Ireland, whereby they have set up a fast track process for the recognition of Irish UCITS and Hong Kong funds for sale to public. So that obviously is very useful for ETFs that will follow prescribed strategies under that framework, but it offers additional opportunities for distribution in those markets as well.
So that is great, and it's great that to touch on some of the tailwinds and also some of the global nature of the Irish UCITS ETF. Because Ireland is the second largest jurisdiction for ETFs globally, and that is because the UCITS ETF is sold throughout the globe. Just noting the growth and the potential for future growth in European ETFs. Shane, could you lead us off on the various options for issuers wishing to enter into the ETF market, from maybe building, partnering, or white labeling, etc.? What are the various options that issuers may want to consider?
Yeah, absolutely. So from an outset, we generally see 3 major themes when people are looking to come into the European market. Some of those have subcategories within them. So buy being one, it's less usual to see that in an ETF context. As the name suggests, it's essentially going out and buying a platform or an umbrella that is already existing, either as an ETF or as a traditional UCITS product. and utilizing that for the housing of your ETF product. The reason we don't see that is there are fewer issuers that are looking to come out of the European market, which is quite positive. And secondly, the due diligence that needs to be undertaken when you're buying a platform in relation to the liabilities, the mechanism by which the fund was set up, the service providers they have, and a lot of the costs are still the same when it comes to doing change of service providers, changing the board, etc. So, the cost savings can be limited there. The second and most common would be to build your own. So certainly for large institutional players that are coming in, either European, as James has referenced, or US managers who are looking to expand their international footprint in the ETFs realm and industry, they will look to build their own product. Generally here in Ireland, for various different reasons, including the often spoken about US double tax treaty, which is beneficial for equity strategies. So in Ireland, that would generally take the form of a corporate structure like an ICAV. The ICAV has become by far and away the industry standard to go to when you're looking to create your own product. And that gives you control over where you want to go, what you want to do, and the mechanism by which you deliver your product. It also allows you to pick your own service providers, your board, etc., as you go along. So it's a positive way of going. The third is then to partner, whether that be with an existing ETF issuer, which is in the market, or with a white label platform. And there are a number of those that have come to market in the last few years. Those are very beneficial and quick to go to market. Certainly, we have seen some institutional managers who are looking to trial an ETF strategy in Europe using that. But generally, they're for the small indie type managers that have come to market. Those have had some success in Europe, and it's great to see. I think they're definitely in Antonette. You'd probably be able to, I suppose, affirm that in the US it's quite normal to see white labeling or partnering being used for indie managers, and it's great to see that in the evolution of the space. Just on the second one, which is building, we generally subcategorize that to actually building your own platform, but also the addition of what we're seeing more recently from other clients is the question of adding in an ETF share class to that platform. That allows you to put your ETF share class on an existing UCITS, but you still have to build the infrastructure around it. So you still have to talk to the likes of James and Virtu and other APs and market makers. You still have to work with the listing and foreign registration in order to get listed on a Deutsche Börse or Euronext exchange or the LSE, for example. So there's still a lot of building that goes there. It's not just the actual infrastructure itself through the corporate vehicle.
Right. And I guess on the white labeling, that's even probably evolving as well, Shane. I mean, we're beginning to see some of the white label providers where they partner and give certain issuers the option to have their own product.
Yeah, they do. And certainly it's a good sign in the European market that we've seen that evolution. We've seen more people come into the white labeling system and ecosystem, I suppose, is the way of putting it. But we've also seen a lot of different things, like the capital market function now can be outsourced to different entities. So that's a really positive development for the smaller managers or the newer managers who are looking to come in. Or if you're based in the US and you don't have a footprint in Europe, because capital markets is generally one of the key drivers, along with the distribution function, the use of the neo brokers, etc., to get to your retail clients.
Yeah. And just Antonette, in the US, there seems to be a rush to the share class, but we haven't seen, as in to get permission, but we haven't seen many actually follow that route actively. Have we seen many in Europe yet?
Well, I think this hybrid sort of approach, if you like, to getting into the market space it's kind of an interesting one in the sense that, on the face of it, it would seem sort of like the easiest option. But particularly to launch an ETF share class and a mutual fund, like it probably is more complex than the asset manager anticipates. I think as Shane referred to, you still have to appoint all of your ecosystem in order to support the listed share class. You may need to re-engineer your existing mutual fund workflow in advance of launching the listed share class, taking into account things like, NAVs ideally need to be calculated at the end of the business day to facilitate the PCF production. Security trades need to be booked on a T+1 basis. They have new order types to cope with, that they haven't come across before, such as directed cash, and they may require, like the portfolio managers, more immediate attention than trading at the end of the day. There's considerations around swing and excluding the ETF share class from that calculation. So I think it is an interesting one. It's one we definitely are having a lot of conversations, particularly with active managers in Europe. But as you say, I think so far there may be something like 140 funds across Luxembourg and Ireland who have either ETF share classes on mutual funds or mutual fund share classes on ETFs. So a lot of conversations, but not a lot of take up so far.
Yeah, because as both you and Shane have said, there's a lot of all the infrastructure needs to be put in place, and then the double taxation treaty isn't available as an option on that one as well. So I just wonder, James, does it affect you guys in any way which structure people use when they come into the market, or what are the core things you need when you're just talking to a new issuer?
Yeah, I suppose probably the biggest differentiation for us is whether someone goes for their own platform or a white label issuer. If it's a white label issuer that we're already set up with and we already have an AP agreement in place, oftentimes that new issuer can actually piggyback on that existing AP agreement. So for us, it just means a bit less paperwork. That's not to say that it's the right way to go for that particular issuer. There's all sorts of considerations in terms of, their distribution capabilities, if they have an existing, infrastructure here already, if they have, existing staff here already, and that all feeds into the decision on whether to go build your own platform yourself, whether you just outsource the capital markets function, or whether you go the full suite and fully white label and outsource capital markets as well. When it comes to the white labeling side of things, there's a bunch of different white label issuers now that we have in Europe. We're seeing even more white label issuers come to market as well. So there's a lot of different options now for investors that are new issuers that are coming to market. So it is about just navigating that. I would say there's almost too much choice now when it comes to the amount of different ways that you can launch an ETF in Europe, which is both a good thing and a bad thing. A good thing in a way that they've got lots of different choice and they're definitely going to find the right path for them. A bad thing in that you kind of need to have domain knowledge in order to find what's the best fit for you. But thankfully, that's where the likes of Dillon Eustace and BBH and Virtu can come in to help new issuers navigate this kind of difficult path, particularly at the start. Two of the things that Shane touched on as well, they're particularly important. One is the distribution network. Obviously, it's selling ETFs is the main aim for these issuers that are launching in Europe, and it's critical to get that right. Knowing the different markets, selling in Italy is very different to selling in France and selling in the UK. So it's requires a lot of domain knowledge, potentially some existing relationships as well. So we're finding new issuers coming to market and setting up offices in these different areas and hiring local people as well, which is great to see across Europe. And the other side, and what we see as the most critical function for the market making side is that interaction with the capital markets team. So the capital markets team kind of acts as this relationship as well as an access point for the market makers to understand the funds, to interact with the funds, to get access to all of the distribution network, to place creates and redeems. But from the very start, it's the capital markets function that we deal with when we're trying to understand how these funds actually work. So when we're figuring out how to structure the primary market for the product itself, when we're trying to figure out how the fund is going to rebalance, when the times of the trades are going to be, etc., we're working with the capital markets team right from the very start. So it's really important that we are in the loop, I suppose, of the whole setup right from the idea, right from when an issuer is beginning to set up till the list date and after, because we can help navigate some of the pitfalls that we've seen other issuers fall into previously, and find the best path forward for that issuer, be it when it comes to the create redeem platform side of things, when it comes to portfolio management, when it comes to the distribution of the portfolio composition files themselves. It all has an impact on the spread of the ETF at the end of the day. And what we're trying to do in working with the issuer is reduce operational frictions as we can, and try and produce the best spread possible.
That's great. And just, Shane, I think you raised those two critical points: capital markets, which James has given some color on, and distribution. And are there any other areas you see that you sort of pick out when people are coming to Europe? You went through a few options on the strategies and structures that you can use. Is there anything else that you think is really important for managers to be aware of when they're coming into Europe for the first time?
Yeah, look, knowing the market and knowing where you want to go. Don't try and go everywhere from day one. That generally doesn't work well. Try and be focused. Look at the big markets. If you're going to go to Central Europe, Deutsche Börse tends to be one of the bigger platform kind of listings that is used, and the rationale for that is Austrian investors, German investors, Dutch investors, Belgian investors, and Lux investors will all use and will all trade via that. LSE is obviously another huge one, and having the access to the market there is great again. And that is remains a huge market for ETFs and more of. The other thing is, I suppose, always ensure that you understand the capital markets function, because it does operate very, very differently to how it does in the US. And it is the key elements to making sure that you do have success within your ETF issuance in Europe. So they're kind of the key things that we always look to see and make sure that the clients understand before going on that journey to bring a product to market.
Okay, no, thanks, Amelia. And then I guess, so, we've talked about the potential for growth, we've talked about the infrastructure, but I think another important area, and you've just touched on it, Shane, but perhaps Tara, you'd be able to add a bit more color to it, is knowing your target market and your distribution and your shop window. Could you maybe talk us through the main markets that you see being utilized in Europe and how they may differ a little bit?
Absolutely. The key exchanges, as have been mentioned, London, the Deutsche Börse, and obviously these Euronext markets that we discussed earlier, Milan, Amsterdam, Paris. And as both James and Shane have acknowledged, these European investors like a local listing. There are dependencies of the local market that are very different, and that goes to the listing as well. But it's always important to recognize that you will have to register your fund for marketing in any jurisdiction which you're going to market and sell that fund. So it's not necessarily going to be tied to the jurisdiction that you are listing in. And as Shane said, we would typically advise promoters to identify their target exchanges early in the process and to go in a focused manner. So for example, if you want to list on London, you're going to have to register under the OL4, and that can take up to 2 months. So you're trying to juggle a number of different exchanges. So if you're listing on the Deutsche Börse, that's under a European passport. So that's going to take 10 days to register that fund prior to your listing on the Deutsche Börse. But you also have to consider then on the Deutsche Börse that you have a 3-pronged process to go through a full listing on the Deutsche Börse. And it has conditions toward that listing that you don't have on other exchanges. So, for example, you have to have 10,000 shares in issue in each ETF in order to proceed with your listing on the Deutsche Börse, whereas London is a passport from a listing on another exchange. So it's a very, very straightforward process, but it means you have to have a listing in place before you list in London. That's typically a listing on Euronext Dublin or something. If you're going for Deutsche Börse first, you're then going to have to be aware that your London listing will follow that. And then, as I mentioned before, you have this new trading platform, the Euronext ETF Europe platform, for Amsterdam, Paris, and Milan. So the take up on that is going to be considerable, I would imagine. So from a single listing, immediately you access those three large liquid markets, subject to having registered for sale and marketing into those jurisdictions as well. So what I would suggest is, identify as part of your distribution strategy where you're going to be marketing, identifying the key exchanges that you're going to list based on your either expressed investor interest or what you expect to see. And then through the application process, starting to the extent that you can, reviewing and putting pieces in place for those listing applications. You will have a fund registration process, and you will have a direct listing application with all of those exchanges. So there's a lot of planning involved, and the processes are very different. So just to bear that in mind.
And I guess another point is, you say Deutsche Börse can be a little bit different. So, for example, when the central bank relaxed its transparency requirements, you still need to be cognizant of the disclosure requirements at Deutsche Börse level.
There is a daily PCF filing, yeah.
Yeah. Okay. And as I say, we touched on an awful lot already in terms of operation and market, etc. Antonette, I guess there's probably a few operational and market pieces that people should be aware of, that, and some of them are just things to be aware of as opposed to anything else at this point in time. But I guess on the positive side, we're seeing consolidated tape come in, which will give a little bit more transparency to the European market as a whole. And there's already talk of tweaking that to make it more efficient again and more useful. But there's also the North America had T+1 last year, but we in Europe now will have that in 2027. Do you have any thoughts on what issuers should be considering around T+1?
Yeah, Brian, maybe just coming back to sort of the point in terms of what we were talking about there about distribution, first, and we do see our book of business obviously listing on exactly as we've said, probably Deutsche Börse, LSE, Euronext, Borsa Italiana, SIX. So they'd probably be the key ones. Just from an administrator's perspective, and we did refer to this, the role of the administrator is really around providing information to those exchanges, whether it be the NAV. I think kind of what comes into play here and touches on your T+1 question is, primary market versus secondary market. So from a transfer agent's perspective, when we're supporting an ICAV, an ETF, we're supporting the primary market. So that's where the APs are coming to the fund to create or redeem sort of in, large amounts. And in Europe, generally, we settle with the AP, or we deliver the ETF shares into their Euroclear, their Clearstream account. Generally speaking, that's particularly for Lux and Irish ETFs. The secondary market is where the investor is going to buy the ETF through their broker. So they may settle on any, of the European settlement systems, depending on what exchange it's traded on. So it really then puts the onus on the AP to be moving inventory between, their Euroclear, their Clearstream account, and where the ultimate end investor is in receipt of those ETF shares. So the onus is falling very much on them. And then when we talk about T+1 and the European moving to T+1 settlement in 2027, that time frame is going to tighten, because we're going to have the secondary market settling on a T+1 basis, and we're going to have the primary market continuing or moving more to settle on a T+1 basis. So, I think it's very much putting that pressure, if you like, on that AP when in that middle role. So there certainly are items that we do need to be thinking about as we move towards that 2027 deadline. And I know, the ETF industry, as part of the wider funds industry, is starting to engage to understand and prepare for this move. But yeah, certainly a lot of it is certainly focused around that converging, if you like, of the primary and the secondary market.
And obviously there's some lessons to be learned from when North America transitioned, but there's probably subtleties and differences to the European market, which means that it's more concertinaed and that people need to be engaged in the efficiencies and, as you say, engaging with industry to discuss how to make the whole trade and settlement as efficient as possible.
Yeah, and I mean, I think those conversations have happened or have started, but I think, yeah, looking for the next year, so it's, and some of it is, just industry conversation in terms of, maybe not setting standards, but at least across the industry, sort of agreeing kind of, general principles. One item that certainly came up in the US, and that was around T0 settlement. So there was a big push for T0 settlement. My understanding is that it's not really used. And that comes back to, that the APs are managing their inventory, better. So there is a less of a requirement for T0 settlement. So, I think conversation, as I said, between all of the ecosystem can sort of flush out these items so that we can go forward, at least, understanding what the concerns are and coming to some consensus in terms of, how we operate.
Great. And James, do you have any thoughts on that from an AP side? Because I guess the big concern is the potential impact on spreads.
Yeah, exactly. The more we move everything towards T1, the tighter spreads are going to be. We're at a stage now after the US moved to T1 where we went through a pretty painful process of operational changes internally, and like model changes, etc. Because if you have a European fund at the moment that settles T2, and face a creation where the US components settle T1, but the remainder of the basket is T2, you have to finance that difference for a day, and if it happens to be over a weekend, then you have to do it for 3 days. So certain days of the week you see this kind of seesaw of spreads because of difference in financing over those different days. We have to be really careful when it comes up to cut off as well on those days in terms of cut off of placing primary market orders, because your costs just doing from 1 minute to the next. So it's tough to manage from the AP side at the moment and having differences in settlement dates. But yeah, certainly the European move will help with baskets that are heavy, where their underlyings are heavy in US and European components. So think of developed world baskets where they're predominantly US and European names. You should see the spread start to decrease on funds like that.
Okay. That's brilliant. I think we're doing really well. We've kept to time, which is great. And we did promise we would be as succinct as we can. I think we've covered a lot of ground. Could I just ask each of you if there's anything you want to add towards in terms of key points that you want to get across? Or if I might just, if you're happy, I'll just wrap up in terms of where I think, and feel free to add to it if you want. But firstly, I'd like to thank you all. I think you've been really succinct and on point, and mentioning all the key areas that need to be considered. So I guess ultimately, the ETF market has experienced strong growth over the last number of years. Ireland's the leading jurisdiction, and all the predictions are it will continue to grow. However, if you're a new issuer coming to market, I think it's important you do your homework, including not just having the appropriate product, as Antonette touched on, in terms of the right product for the right time, given the volatility we have, etc., but also the operational points that you each discussed, the relationships that you each discussed, and your distribution strategy. So, and finally, as mentioned at the outset, we will circulate a recording of this to everybody, and please do feel free to follow up. As you can see, we have a panel of experts that can answer all your questions, so feel free to reach out to any of us if you have any follow-up questions. Thank you.